The amount of money going into US stock market ETFs recently hit $150 billion, a number that's only been reached once in the last decade in 2021. This is right as the main US stock market index, the S&P 500, is making a record advance so far in 2024, being up so far over 26%. At the same time, something called the PE ratio of the stock market is reaching heights that's also only been witnessed once in 2021 and once in the late 1990s. This PE ratio is ultimately a measure of how expensive the stock market is at any given point, and it shows us that the current pricing of the S&P 500 index is in the 90th percentile of the last 40 years. And many analysts, news outlets, experts are calling this an irrational market, or even worse, an irrationally exuberant market. Now, you'll notice that some of these news headlines actually date back to February of 2024. If we look at when that was on the S&P 500 index, that was right here. The index has moved up by another 18% since then. In fact, if we zoom out to see December of 1996, we also know that Alan Greenspan, who was the head of the Federal Reserve at the time, called the stock market irrationally exuberant. And indeed, it looked like the stock market was excessively bullish heading into December of 1996, having moved up by over 60% over the course of 2 years. But look at what happened after he made his speech. The S&P 500 continued to move higher for another 3.5 years, doubling in price. And he wasn't the only one. The entire way up, very intelligent people were calling the stock market dangerous. As the saying goes, the market can stay irrational for longer than you can remain solvent. And that definitely applies to the stock market today. Ever since the movie The Big Short came out, people have been trying to act like Michael Burry and bet against the stock market. But meanwhile, the S&P 500 has continued to steadily climb higher. So who is the dumb money today? The people selling stocks or the people piling into US stock market ETFs? By the way, there's not much time left to take advantage of our Black Friday offer. If you want to have access to our entire trading strategy, including alerts for all of the trades that we participate in, make sure not to miss this offer. Believe it or not, the exact same forces that drove the huge rally in the late 1990s are present today. We have a real economic growth today that is hovering at around 3%. That's smack down in the middle of the range where economic growth was in the 1990s during this incredible bull market in stocks. In fact, all of the periods where economic growth was around these levels led to huge bull markets in stocks. That's why, in our opinion, the biggest risk to the stock market today is a recession, because that brings down economic growth and can cause considerable declines in stocks. One of the big things that we're watching for with our clients is the state of the US job market. This is a chart showing initial jobless claims in the United States, and it's updated weekly, so it provides a live view of the state of the job market. And one of the typical things that you see heading into economic downturns is that initial jobless claims begin to pick up in the few months before the recession actually starts. By the way, these recession bars here are simply the official NBER recessions. Now, if we zoom in a little bit closer into what's going on today, we see that initial jobless claims have actually been moving down over the last few weeks. And overall, they've generally been going sideways over the last year or so, not something that's indicating an imminent recession. Now, if we superimpose something called the yield curve on top of initial jobless claims, first of all, we see that it's almost a perfect indicator of where the job market is going next, and all of the moments where the yield curve has been inverted throughout history has been closely followed by a pickup in initial jobless claims. So to us, this time is not different, and we are going to see initial jobless claims begin to pick up, but we want to see the actual data begin to point in that direction. For now, initial jobless claims are behaving in a very similar way to previous stable economic periods. Again, all moments where the stock market was generally moving higher. So for now, although there are signs of a recession, economic growth seems to be relatively stable. But there is a second big similarity between today and the late 1990s, and that's what the Federal Reserve is doing, the US Central Bank. Ever since mid-2023, they've kept their interest rates stable and even lowered them very slightly. As you can see, that's very similar to what they were doing in the late 1990s. Now, as long as economic growth is stable, this type of stability in interest rates is allowing stock market investors to get very very excited. Now, back here, the stability in interest rates was primarily fueled by steadily declining levels of inflation in the United States. This is a line showing the core consumer price index, which is one of the preferred measures of inflation for the central bank. And back here, the fact that core inflation was steadily declining allowed the Federal Reserve to do what they did. Today, we've also seen core inflation move down substantially over the last couple of years, which again has allowed the Fed to do the same thing they were doing in the late 1990s. Now, as you can see, there's been a slight tick up in inflation recently, and for the first time really since 2022, and this is already getting a lot of people very concerned about the possibility of the Federal Reserve needing to raise interest rates again, which would stop the bull market in stocks dead in its tracks. But if we rewind to the 1990s, we can see there were many temporary ticks up in core inflation, but they didn't derail the overall downwards trend in inflation. And this is what we've been telling our clients for the last year. Our research has been suggesting that inflation should head down, and that continues to be the case today. Why, yet again, we were advocating to buy this recent dip on the S&P 500 because we just don't have any signs yet that the bull market we've been in throughout 2024 is coming to an end. Now, we did send out last week a quick notification for our clients saying that institutional money managers are leveraged long right now from the data that we're looking at, and that does increase the odds of a little bit of short-term volatility in the market. Now, to be clear, we're not making an outright call on a market correction right now like we have before, but we've generally rebalanced our trading portfolio to make sure that we're accounting for this risk. Today, our portfolio of trades is extremely diversified. We are currently long on crypto, which is really not always the case. We've been taking advantage of the strong momentum on crypto, which is the only moment you want to be long on crypto is when it has momentum, and those positions have been doing incredibly well. We've been long on Turkish stocks over the last few weeks. That trade has been playing out nicely. We have trades on Malaysian and Chinese stocks as well. Both of these have been dipping recently and could end up having been fantastic buying opportunities. We also recently bought the dip on a uranium miner called NXE because we could be about to see a resumption of the bull market in uranium prices. Part of our allocation is dedicated to US utility stocks. That sector is one of the only parts of the US market that actually looks reasonably priced today, and it also has fantastic technicals, which is a combination that is very rare to find in today's market. And then we have a bunch of other trades that we like. So far in 2024, we've had 104 trades, 68 of them have been winning trades, and 36 have been losers. You can check out our close trades on our homepage. If you don't want to miss the next ones, make sure to take advantage of the Black Friday offer that we're doing this week. We never do these types of discounts, so don't miss your chance.